Hello everyone, and welcome to today's presentation. I'm excited to share insights on mimicking institutional-grade execution for sharper market entries. Today's focus is on achieving that level of precision that professional traders use. We'll explore how to optimize risk-reward ratios with precise entry points, leveraging sophisticated smart money concepts for superior trading results. Our goal is to understand advanced execution strategies, including order block refinement and smart money tactics, to improve your trading performance. Let's dive in and discover how to elevate your trading game to an institutional level. Refinement transforms broad zones into exact entry points, making our trades more precise and targeted. By honing in on specific areas, we reduce the risk involved and minimize potential drawdowns, helping us protect our capital. Institutions, for example, execute their trades with a high level of precision, and that's what we aim to do as well. When we look at wide stop-loss levels, it usually means a lower reward-to-risk ratio, which isn't ideal. Higher timeframe order blocks tend to be too wide, making it harder to pinpoint optimal entries. That's why order block refinement is so essential. It allows us to narrow down those zones and find the most accurate entry points, ultimately improving our trading performance and consistency. Refinement is really about dissecting these broader zones to find the exact price point where significant order flow has taken place. It's about honing in on those precise levels that reveal where the big players are truly executing their trades. When we talk about identifying true execution, we're focusing on those key price levels, like the open of a candle, the origin of a wick, or areas where the market shows signs of inefficiency. These are the points where institutional orders tend to cluster, revealing where real buying or selling activity is happening. And it's important to remember that large financial institutions don't usually execute their orders all at once across a whole zone. Instead, they break their trades into segments, executing strategically in parts. This segmented approach helps them minimize market impact and get better prices. So, understanding this, the core logic of OB refinement is to get beneath the surface, to see where these true orders are really being placed, rather than just the broader zones that might look interesting at first glance. This process allows us to align our trading strategies more precisely with where the real action is happening in the market. Let's dive into some key concepts that help us identify high-probability setups. First, the presence of a strong displacement candle is a clear sign of aggressive institutional participation. When we see that, it indicates big players are actively involved, pushing the market in a certain direction. Remember, no displacement usually means no refinement, so look for those strong candles as a starting point. Next, a confirmed break of structure, or BOS, is crucial. When the market breaks a significant level and that break is confirmed, it signals a shift in control. This validation helps us trust that the market is transitioning into a new phase, making our setup more reliable. It's also important to ensure that prior liquidity pools have been swept. This indicates that smart money has moved out of certain areas, creating opportunities for others to follow. Watching for liquidity being taken is a key part of understanding institutional activity. Additionally, we need to confirm that there's a clear higher timeframe trend. Aligning our trades with the dominant market direction reduces risk and improves our chances of success. So, always check the higher timeframe to see if the trend is bullish or bearish before refining your entry. Finally, refining our order blocks should only happen when specific market conditions are aligned. This ensures we're setting up in high-probability scenarios. So, always verify that the market conditions are right before acting. This approach keeps us disciplined and increases our likelihood of success. This is where institutions execute with surgical precision. When you look at the start of the wick, especially if it indicates a liquidity sweep, that's a critical area where institutional players often step in. It's essential to focus on the wick origin because it provides insight into where the true institutional interest lies. Now, the 50% retracement level of the order block candle can serve as an additional point of confluence. This means that if the price retraces halfway into the OB, It's a strong confirmation that institutions might be involved, making it a key level to watch. Also, don't forget about the opening price of the order block candle. This often acts as a significant institutional entry point because institutions tend to enter at or around the open of these key candles. Marking this open level can give you a valuable reference for potential entries. To get more granular and precise, we need to transition to a lower time frame, dropping down from M5 to M1. This allows us to analyze price action in greater detail and identify exact entry points with more confidence. And of course, the first step is always to identify a valid higher timeframe order block, whether it's on H4 or daily. This higher timeframe context helps us understand the bigger picture and creates a solid foundation for our trades. Overall, this candle-based refinement method is about dissecting candlestick patterns carefully to pinpoint the precise moments when institutions are likely to step in. By combining these elements, wick origin, retracement levels, open prices, and lower timeframe analysis, we improve our chances of catching those high-probability institutional entries. Let's dive into some key confirmation signals that indicate real smart money entry. First, when you see a strong rejection candlestick pattern or an engulfing candle, it's a solid sign that smart money might be stepping in. These patterns show a clear rejection of higher or lower prices and often mark the beginning of a move in the desired direction. Next, look for a sweep of local liquidity on the lower timeframe. This liquidity sweep often happens just before a strong move, acting as a catalyst that clears the way for a breakout or trend continuation. Another crucial point is observing a shift in market structure on the lower timeframe. When the market structure changes, say, from bullish to bearish or vice versa, it indicates a shift in the immediate direction, giving us a clue that a new trend might be forming. Now, as price interacts with your precisely refined order block area, pay close attention. This is where institutional players are likely entering, and their activity is typically reflected through price action around these key zones. Finally, after price enters your refined order block, it's important to look for confirmation on lower timeframes. This confirmation helps validate your entry and increases the probability of success. By combining these signals, we can better align our entries with smart money moves, which ultimately enhances our trading edge. This confluence leads to high precision, low drawdown trades. When we trade from the confluence of an order block and a fair value gap, or FVG, it significantly increases our entry accuracy and helps us reduce potential drawdowns. The most reliable setups happen when an FVG aligns directly with or is inside your refined order block, creating a stronger case for a trade. A fair value gap represents an imbalance where aggressive buying or selling has occurred, leaving unfilled orders behind. This shows market inefficiency. Essentially, the FVG acts as a magnet for price because it highlights areas where the market hasn't fully corrected itself. Using FVGs for refinement is powerful because they indicate inefficiency and attract price action. When we see an FVG overlapping with an order block, it signals a high probability entry point due to this combined confluence. This approach helps us pinpoint better entries, making our trades more precise and less risky. Let's talk about the importance of a small stop loss in your trading strategy. A tight stop loss can significantly improve your potential risk-reward ratio, which is key to more effective trading. Typically, for Forex pairs, aiming for a stop loss within the 5 to 15 pip range allows you to maintain higher reward-to-risk ratios, making your trades more efficient. It's important not to use the entire, wider range of the order block for your stop loss. Precision is crucial here. Setting a tighter boundary helps protect your capital and keeps your risk in check. For bearish setups, you want to position your stop loss just above the high of the refined order block. Conversely, for bullish setups, place it just below the low of the refined order block. This careful placement is all about optimizing your stop loss to maximize your reward-to-risk ratio and preserve your capital. Remember, smart stop loss placement isn't just about protecting yourself. It's about setting yourself up for consistent, disciplined trading success. When it comes to precision in trading, it's really all about sticking to your rules rather than relying on guesses or speculation. One common mistake is entering a trade without waiting for confirmation from the lower timeframes, the LTF-MSS, before jumping in. Relying solely on the refined order block can be risky if you haven't checked where the liquidity is or where the next liquidity grab might happen. Another pitfall is over-refining the order block into an overly tight zone. While it might seem like you're getting more precise, it actually increases the risk of being stopped out prematurely, which can be frustrating and unproductive. It's also crucial not to ignore the higher timeframe bias. Trading against the main market direction can lead to unnecessary losses. Always align your trades with the overall trend. Refining weak or invalid order blocks is another mistake. These often lack the institutional characteristics that give us confidence in their reliability. Focusing on strong, validated order blocks is key. To succeed, avoid these common pitfalls. Proper refinement and adherence to your rules help ensure you're making consistent, effective trades, keeping your profitability on track. Now, as we wrap up, it's crucial to remember that to succeed, we need to refine our approach like institutions do, execute our trades with the precision of professionals, and aim for consistent results. When you're ready to execute a trade, make sure all the key criteria are in place. For example, ensure your RR is at least 1 to 3, meaning your reward is 3 times your risk. Confirm that the LTF-MSS is verified and that the OB has been refined correctly. Also, double-check that the BOS is confirmed, liquidity has been taken, and the HTF OB remains valid. All these points are part of our order block refinement checklist. It's essential to go through this checklist thoroughly before placing a trade. By doing so, you're aligning your process with the standards of professional trading and increasing your chances of consistent success. Remember, it's about ensuring every criterion is met so that your trades are based on solid, well-verified setups.